top of the hour, so I'm going to go ahead and kick this off. Good afternoon, good evening, good morning for some of you. Welcome to this next installment in the MJSA webinar series, Let's Talk About Money. We've been offering the MJSA webinar series for nearly 2 years now, but during the COVID crisis, we have bumped it up from every third Thursday to every week, and we've made it free for the entire industry to help everyone navigate this coronavirus crisis. We will continue to offer the MJSA webinars through the end of June on that weekly schedule. Today, we are going to talk with a panel of experts on the money crisis that we are facing, because we are in a liquidity crisis. We are experiencing dramatic changes to the way we look at credit and creditworthiness and cash flow. And we need some experts to guide us through those topics. So we have some. I'd like to introduce to you Ann Arnold. Ann was, she comes from the jewelry business. She was the CFO of a family jewelry business for a long time. She's a CPA. She is now the Chief Strategy Officer for Buyers Intelligence Group, or BIG as most people know it. And she is the new chairperson of the Jewelers Board of Trade. So welcome, Ann.
Thank you.
And we have Joel Peck. Joel is a CPA serving a broad variety of small business owners and individuals across multiple industries. He does have experience in the jewelry industry, so he brings both core knowledge and the external perspective that can be very helpful to us. So welcome, Joel.
Thanks.
And we have Erich Jacobs, who is the president of the Jewelers Board of Trade and comes from both the money and technology backgrounds that the jewelry industry is finding we need to embrace more and more. So welcome, Erich.
Hello, everybody.
And I'm just going to kick this off pose a question or two, and you guys start talking, and let's hear what we can learn from you today. So as I mentioned, we are experiencing a liquidity crisis and a really unprecedented moment in how we manage our businesses. And I guess the first thing I'd like you guys to discuss is, when you're advising your clients or customers, or working within your own organization, what is the thing that you think people should be most focused on right now when it comes to their money?
Oh, I'll start that one. Hi, everybody. The thing that I feel is most important is not making tomorrow's decisions based on yesterday's metrics. We're done with yesterday. This is all brand new. So what you've got to do is certainly be flexible, but really be honest about every one of the metrics that you're seeing, because they are not the same as they were. They're probably not going to be the same as they were for a while. And to make decisions based on what you used to feel comfortable with is just going to get you in trouble.
So what's an example of that? Like, what kind of a metric do you think people might grasp onto today that worked for them yesterday that they need to question now?
My clients, especially in seasonal businesses like the jewelry business, they'd have strategy sessions that usually go based on a season, whether it's off season or on season. I'm telling every one of my clients, forget season, forget month, at least for the beginning. You've got to do these cash flow projections weekly.
Weekly, okay.
I agree. I think that what we've done in the past a lot is look at sales and use that as our base metric and build budgets off of what our projected sales are. And I think that has to be thrown out in general. I think we have to start looking at reality. I think we have to put best practices that should have always been in place, but maybe we just kind of didn't do it. We've got to start really thinking about those best practices. And I'll give you as an example. We always hear, keep a little kitty for a rainy day. And that's really easy to say, but very difficult to implement. And so even though it seems like the sky is falling, I don't want you to forget about those basic core practices. Even if it's a few $100s a week that you just store in a separate account or put on the side, start building that up, because even though we're in a quote unquote crisis mode, you still have to look at it as if your business is going to succeed. And what are you going to do to make yourself healthy again?
Yeah, and from our standpoint, when you look at the larger ecosystem in which everybody operates, we think that an important thing that everyone needs to do from a management perspective is just keep the lines of communication open with all of your suppliers and anyone else that you're dealing with. Even if those are unpleasant conversations, keep those lines of communications open, because at the end of the day, you need to have the financial flows happen, and anybody within the, call it the financial supply chain, if they get surprised, it kind of hurts everybody. So from our perspective, we really recommend a very open communication approach, regardless of where you're at from a financial perspective.
And that's always been the rule, right, Eric? Always keep the lines of communications open with your financial partners so that they don't get surprised. That's not new.
That's not new. But obviously, there's a lot more unpleasant conversations that happen right now, right? But the good news there is we're still in that kind of everybody is in this together moment. I think we're dropping out of that a little bit as things are opening up. Folks are sort of saying, "Hey, these guys are open; they can pay," that kind of thing. But for the most part, we're still in a situation where even having those unpleasant conversations is a lot easier than it used to be.
In the absence of communication, people just make assumptions. Right. And they're not generally helpful.
Fair enough. So, it's interesting. Individual businesses are used to being in a liquidity crisis from time to time. And as over-leveraged as the jewelry industry has been for years, I think there's been some general liquidity stress. But we've never gone through a global liquidity crisis before. So what kinds of things can individual business owners do? What kinds of targeted actions can they do in this moment to support some more financial strength?
So I think one of the things, if you look at your balance sheet and you think about what assets you have, most jewelry stores, their biggest, I would question whether it's an asset or a liability, to be quite honest, is their inventory. And so I think they need to take a hard look where they were kind of just going along the way it was. And some people manage their inventory much better than others. Some people buy pretty stuff and others buy for their consumer base. I think everyone needs to start shifting their thinking and looking at the biggest asset that they have and how can they realistically convert that into cash. And people may say, well, I've had this aged inventory. What's going to change now? It's about your perspective. So I'll give you an example. Right now, you have aged inventory. This is the perfect time to start re-merchandising your stores. Start thinking about starting from scratch and looking at the product. Does it fit the right price point that it's in? Should we move it to a different price point that perhaps we have a hole in? And let's not forget, there's two sides to the equation. We've got retailers and we've got vendors. And as hard as the retail community has been hit, the vendor community, I would almost argue, may be hit even harder coming down the road, because as retailers open up, they're not in a mood to buy. And you've got vendors that are knocking on the door and they have to be very careful. The vendor community needs to start thinking about, how am I going to approach this new next differently? How am I going to change my relationship with my retailers to be much more consultative based on consumer behavior rather than just selling stuff in?
Well, and that lag for the suppliers is going to be fairly long, because the retailers are going to be selling through inventory, right?
Mm-hmm. Yes, and that's why we have to think differently.
Yep. Joel, you were going to say something.
Yeah, so here's where I get to be the bad guy. And for everyone on the call, please understand I am an optimist through all of this. When I say I'm going to be the bad guy, because I'm going to talk about taking inventory that didn't sell for the last 5 years and is probably not going to sell right away, melt it. Spend the money, whatever you have to sacrifice to get the stones out, break it up, melt it. It will provide immediate cash, and you need immediate cash. If you're not going to get it from sales and you're not going to be selling this stuff, get it from this stuff another way.
Well, because technically, if it's 5 years old inventory, it's 4 years past its prime, right?
That's you talking and that's me talking. That's not my clients talking. But then again, I still have some who are waiting for the I still have some who are waiting for the Christmas of '99.
Oh, that was a pretty piece, though. I'm sure it's going to sell one day. My dad really liked it when he bought it.
I'm sure he did.
Clearly, you've lived through those discussions, Ann.
Yes.
So what else should people be doing right now? So inventory is a big place to go and get some cash and get you through for a period of time. Is there anything else people can do in terms of changing business policy or practice to help add some resilience if they weren't prepared going in?
Ann started this by saying, looking at the balance sheet.
Okay.
Line by line. Because again, today's not yesterday. So there are things that you accumulated. Some equipment you're going to have to replace if you want to go to the next level. Where are you going to get the money to fund those leases or those equipment purchases? You really have to go line by line and find out where your strengths are, where your weaknesses are, what can be converted to cash, and move on. On the debt side, take a look hard at what debts you have. I assume at some point during this conversation, we're going to be talking about the SBA loans, but they're a great opportunity to take other loans that you have and pay them off.
Mm-hmm. At a much lower interest rate.
3.75% for 30 years. Tell me when that's coming back.
Right.
For almost no documentation.
Yeah.
Right. And then once you're done with the balance sheet, take a hard look at your income statement, line by line, every expense. And remember, there's a difference between a fixed expense and a variable expense. And make sure you differentiate between those two. Everybody's had to learn how to do things differently. We keep saying that word, but start really taking that hard look internally and saying, do I really need that? Or if you do, am I doing it in the most efficient way possible?
Well, the new definition of fixed expense is, remember back in April when you had no sales, what'd you still have to pay?
Right. Yep.
That's it.
I want to bring up another point. You talked about liquidity. For many years, the relationship in the industry was pretty much that a vendor community financed the retailer community. We gave terms out. Ultimately, you either went to the bank and got money, or you went to your vendors and said, I can't pay you for 90 days, 120 days, whatever it may be. Many vendors, and a lot of retailers don't realize this, many vendors were, especially for some of the majors that they were working with, had credit insurance. And so what they were doing was they were insuring their accounts. And they were basically guaranteed to get paid on some of those accounts. Maybe not all the independents, but for their major business, which helped fund the independents. Now what we're seeing, and Erich could talk to this as well, is that credit insurance is starting to not only, whether it's going away or tightening up. And so those vendors that typically were helping to fund the industry, are they themselves now getting squeezed, and they're not going to be able to give the terms and credit that they were able to give before. It's going to be much more important for them to sell to the right jewelers, the ones that have the right, quite honestly, credit ratings through JBT. They're going to be looking at that a lot harder, and they need to, because the funding for them isn't what it used to be. I'll let Erich go from there, but.
Yeah, no, I would agree with that. That essentially we are hearing. In fact, we had some updates just this past week that the credit insurers are basically shutting down in some accounts, basically saying we will not insure these accounts going forward, and so then it leaves it sort of in limbo of what does that really mean. What we're also seeing is an expansion of sort of alternative sources of capital as well. So. For example, some of the new online platforms that provide e-commerce capabilities for some clients, they are now actually starting their own capital funding facilities. There's one of the major ones just announced $1.2 billion in capital availability for their platform users. But those will be based on, probably more traditional metrics, not, being credit insured or something along those lines.
So if this leads me to a question. So if the credit insurers are backing out, and that has been funding a lot of the jewelry industry, do we expect that to return to normal quickly? Like, even if the crisis passed in a year, would the credit insurance policy change right after that?
Yeah, if 2008 was any indication, right, our last major recession, they walked away from the business for a number of years.
Okay.
And so what that means is that a lot of these providers, what's that?
It wasn't about 4 or 5 years that they walked away from the industry.
About 4 or 5 years. And then they kind of slowly came back in, right? And all of a sudden we turned around and, oh, wow, they're a pretty dominant force in the industry again. So a lot of these folks, it's not just the fact that they don't have that insurance available, but they're going to have to change their internal processes, because it used to be, oh, are they on the insured list? Great, let's go. Now it's, no, we're going to have to do credit ratings on our clients, right, where they didn't have to before, and that's a different process for some of these guys, and they're going to have to adjust to that.
So if the vendors are being squeezed and they don't have credit insurance, we're looking at some very fundamental changes in the financial dynamics of the industry, aren't we?
It is, and I want everyone to also understand that if a vendor doesn't have credit insurance, if they have a line of credit or any kind of bank loan, many bank loans that are asset-based or receivable-based, they cut them off at 90 days. That's why the magic number is you got to pay me in 90 days, because many vendors lose the ability to borrow on their line for any receivables over 90 days. So as payments are starting to slow, if the banks aren't going to be responsive to keep the money flowing, that's going to squeeze the vendors even more.
And I'm not a salesman for the SBA, but the SBA 7A disaster loan is written as a working capital loan. Right. That's its point. That's why it's such a great idea to take part in it.
I was going to say.
I'm sorry. Go ahead.
One other change that's happening in the capital markets is that something that's silently been going on in the back end is the number of basically no covenant loans that banks were making over the period of time had been increasing, basically silently in the background. And you can kind of think of these things as somewhat equivalent to, it's not exactly, but somewhat equivalent to the no-doc loans you always heard about during the housing crisis, right? These are basically no covenant loans. That's going to stop too, right? So that's going to change sort of the availability, at least how it looks coming from banks as we go along going forward.
So then I start, but you guys tell me if I'm wrong. I start to draw this conclusion that one of the keys to competitive, if I could say it, one of the keys to competitiveness for our retailers is likely to become their ability to pay bills on time and manage cash flow and sales. And that has not been a key to competitiveness in the past.
Another danger that I'm seeing is my retailers in the early days, if the business didn't have the financial resources, they just loaned the business money. Well, if they didn't have much more than 6 months of an emergency fund personally, and they're now dipping into that, you've got this layered cascade of disaster coming. You know, people are borrowing from their future for what should have been a disaster cushion to solve the first disaster cushion, but then there's another one coming.
Yeah.
So I would say to that as well, and we talked about it, I find especially what we've noticed at Big is that so many people are afraid of the numbers. They don't really understand it. They feel that they're not financially literate. And so there's almost this fear of being able to embrace them. And what I want to encourage you all is get comfortable with your numbers. Start looking at them much more frequently than once a year when you have to get your taxes together for your accountant. Start looking at them at the very least monthly. Start really owning your numbers. That's what we call it, own your numbers. Understand how to do a break-even analysis. If you don't know how to do a break-even analysis, start to learn. And I know, Andrea, I told you, if you want, I'm just letting you know, at bigjewelers.com, Andrea, I'll give you the link. We have a bunch of resources and there's free downloads of spreadsheets, a break-even analysis spreadsheet, a cash flow spreadsheet, to help you figure out, where do I start? Because so many people are so afraid and they don't know where to start. It's never too late. Don't get discouraged. Please remember to just start.
It's so important. Most people's fear of the numbers is just that, fear. If you can run your business, you can learn your numbers.
I remind people, you don't get sick because you go to the doctor. You don't pass away because you go to your attorney and write a will. And you don't go bankrupt because you look at your numbers.
That's good advice, Joel. Somebody is asking a question right now that's really relevant to this. She's saying, so does this mean that vendors should no longer give out their merchandise without getting paid at least partly upfront? And this really affects our designer community, who's also on this call.
And I think that really depends on your position and where you're at. This is not we're sounding the alarm, every retailer is going out of business. That's not what it is. There are many retailers that are very properly positioned, prepared. They have an online presence. They're forward thinking. So I would say to that, not necessarily. If I would go and sell a retailer, what I would do is, number one, pull a JBT credit report, check their rating, check their history. JBT, what we've done at JBT is we're giving pre and post COVID ratings so that you can have an understanding of how this has affected the retailer. Speak to the retailer up front. See how they're going to be selling their product. Do they sell online, or are they only waiting for the store to reopen for people to walk in? So it's not a yes or no answer. I think it's a get to know who you're selling better answer.
That makes me think, Eric, a couple of weeks ago when we were talking, you said that JBT was starting to do that pre and post COVID rating. Mm-hmm. Things keep changing. Is there any new insight on how you guys are looking at that right now at JBT?
Well, in terms of the ratings, there's no short-term plans to change how we're doing that. We continue to have the pre-COVID rating and the post-COVID rating. And in fact, as I think we mentioned in a previous webinar, there's a built-in lag between some of the rating information, because it takes a while for it to get to us, flow through the pipeline. Or a simple thing to think of is, it takes 90 days for somebody to be 90 days past due, right? So it takes a while for that system to kind of go, or that data to go through the system. We are spending a lot of time looking at the data and seeing if it's giving us an indication of, have we bottomed out yet? I can tell you, doesn't look like we have quite yet. But we are also seeing signs of life in terms of some things coming back to some metrics. We look at it about 70% of normal. So there's some mixed bag of things going on there. We are continuing to track that, and we are continuing to look at how we can modify what we do for the betterment of folks. As Ann said, one of the best things you can do in terms of a relationship with a new client is pull a JBT credit report. Because if it hasn't been refreshed recently, merely the request for that credit report will cause it to be refreshed. And when we refresh it, it's not just somebody hitting a button, it's actually investigators and analysts going back and looking at, okay, what's really happened with this client in the past 12 months.
And that brings up that brings up a point. And this is for both retailers and vendors. JBT actually relaunched their website right now, and you have the ability to own your own listing. And what I mean by that is update your own listing. No one's, we can have our investigators go and call you up to see what's going on, but it's great if you could be proactive and make sure that JBT has all your current information. It's so important. And especially now, it's going to be even more important, both from the retailer and vendor community, because retailers have the ability to pull reports on their vendors as well to make sure they're financially sound, that if they're going to invest in your line, you want to make sure they know that you're going to still be around as well.
Well, that's right in line with what I was just about to say too. JBT did not ask me to make a plug on this. They just came on as a favor to us. But for those of us in the jewelry industry, and this is really important for all of you smaller designers that are on this call, that where we get lower participation, I think, in JBT, from what I can tell. There are lots of credit rating agencies out there, but as we all know, accountants, bankers, credit ratings, people who don't understand the jewelry industry, they really don't understand the jewelry industry. JBT is a really important resource, and it's important more than ever, I think, for you guys to be using it and listed in it. So anyway, that's my unasked for plug.
And I will say, on the good side, as Erich said, we look at metrics at Big also, because we aggregate quite a few $1 billion of data, and we're noticing as well the uptick, and that we're starting to see sales coming back, especially as states are opening up, which is a very promising sign. Things are coming back to life.
Well, okay, so Erich, you said some metrics are up as high as 70%. What are you guys seeing in the numbers? Do you have any nuance that you can give to that statistic?
Yeah, so when I say the metrics, I kind of focus on the 70% number is really activity metrics.
Okay.
So you look at things like the number of credit reports being pulled and overall just action for other what we call operational metrics. Those are getting up to about 70, even last week, about 75% of what it was when the pre-COVID. From a financial perspective, as I said, I don't think we've quite bottomed out yet. If you look at even just the broad economic metrics, right, things are still negative. They're getting better, but they're still negative, and some of those are cumulative metrics, right? So unemployment numbers, right? Yes, each announced initial unemployment claims is a little better than the last one, but it's cumulative. So we don't think we've quite reached bottom yet, and it's a little hard to tell where we're going to end up in terms of things opening up and its impact on the overall virus and how long that's going to last, right? Whether it's going to be a second peak, it's going to be a flattening out. This is like the next 2 weeks, I think, are going to be critical to kind of figure out where that's going.
So let's shift gears and talk about some of these relief options that are available. Well, and are they relief? So PPP, is it giving anybody relief? Is there anything new they need to know about it? Other SBA programs, because they've got about 4 of them listed at the moment. So what should people know about these programs or other programs?
Well, the bad news is also the good news, and that's they're changing the rules in the middle of the game. So they issued the checks. If I could just remind everybody, bring everybody back to the end of March, beginning of April. April was 92 days long? So the end of March, they announced PPP and essentially encouraged businesses to not fire their employees, that there would be this PPP loan. It would replace the money that you were paying your employees. That was great. So that was the end of March, beginning of April, the system crashed. Nobody could file until around the 10th to the 15th. They got their money May 1st and were told, oh, whoa, wait a minute. You have to use this money for the next 8 weeks. The last 6 weeks is on your dime. We're not going back to that. Then what happens? Okay, so that's May 1st. Most of my clients are in New York City. They're not opening. So what are they going to pay their employees for? And when? And now the PPP is they're looking to extend the 8 weeks beyond that because, again, everyone expected that this thing would blow over early summer. So those rules are changing. The SBA started out with frequently asked questions. I think they're at 50 now and constantly adding and changing. And I'm on webinars with other CPAs regularly where they talk about, you know what, we'll answer this question at next week's webinar when they give us the answer. And that's continuing to go. So don't feel, I guess my overall point is, don't feel burdened by rules that you think are there that clearly don't make sense because they are changing.
And I want to add to that. If you haven't applied for a PPP loan yet, apply for it because you need to get in line and you want to make sure you get it. And I want to make sure that everyone understands the PPP loan has a forgiveness element to it, but it doesn't necessarily mean, number one, that everything will be forgiven or that you even have to ask for it all to be forgiven. Ultimately, the PPP loan allows you to borrow money for 2 years at a 1% interest rate. You're never seeing that. So even if you ask for more money, don't get caught up in how much is going to be forgiven. look at it as, you know what, I'll be able to pay some expenses. And again, there's rules about which expenses you can cover, but it's still a really low interest short-term loan that you can utilize. Now, as far as the PPP part, as Joel mentioned, there is so much still changing to address the fact with the 8-week period, what's included in the 8-week. And I don't want to get too in the weeds with everyone between incurred versus paid. There's a lot of conversation about it. It is a lot of paperwork. Don't get discouraged by it. You might as well apply for it. You can always just pay it back. You don't even have to pay it back with any interest at the beginning if you want to just all give it back and feel like it's not for you.
So Howard's saying, I don't think the SBA disaster loans are available for anyone except agricultural businesses. And I'm hearing that a lot. There are 3 SBA programs, I believe, right now, plus a consolidation program. So maybe you guys could speak to a couple of the different things that are available.
Well, just to the agricultural piece, I filed 3 7A applications last week, right into the face of it only being for agricultural businesses, because it's going to open up.
So you're saying since the rules are changing, don't worry about it.
Go for it.
The worst that happens is you don't get it.
Okay. What about this up to $200,000 program that you've mentioned, Joel? Let's talk about that.
Which one?
The one that's up to, what's the name of the program that you can get up to?
Oh, the 7A, the disaster loan?
There was the $10,000 one, then there's the up to $200,000 one, and there's the PPP. Help us sort that out.
Well, the 7A disaster loan is in fact a loan, but it's got the best payment terms going. It's designed as a working capital loan, originally for businesses who suffer hurricane disasters. That's what it had typically been used for. Now it's still, it's out there. I hesitate to get a bit in the weeds, but I just want to remind everybody, if you take a PPP loan and use it for employees, you're not going to get the deduction for the salary, and you're not going to be charged with income on the forgiveness of the loan. If you take the loan and you pay other expenses, they're deductible because you're going to have to pay that loan back, granted 2 years, 1% interest. So if you're not actively speaking with your financial advisor, CPA, get on the phone with them after this call. There's all sorts of weeds to flow through. It's maddening on my side, but you get the benefit of it.
And I want to, Andrea, you mentioned the 10,000. So Joel, correct me if I'm wrong. The 10,000 that people keep hearing about is a subset of that loan. All it is an automatic $10,000 grant that you don't have to pay back. However, if you get that $10,000 on one side and you get the PPP on the other side, it's going to reduce the amount of your PPP loan.
And the 10,000 was then scaled back to 1,000 per employee. I mean,
right.
It's really, it's like standing at the craps table and throwing a dice.
So what you just said was the most important, which is stop trying to interpret. This is why we have specialists. Stop trying to interpret all this stuff by reading links on Google or social media from other people who aren't accountants. Talk to your CPA.
Why should 100 of you research the stuff that I'm researching, which can benefit 100 people with one bit of research? That's what I do.
And I believe there is a question about the EIDL and the PPP. You can apply for both as long as you use it for different purposes. So yes, you should accept them both if you're going to use them for different purposes. But if you're using it for the same purpose, that's where the problem is.
Somebody said they got the notice about the disaster loan and thought it was a scam. I found out it wasn't. It's legit.
It's just so easy to get that you really don't trust it's real. True fact.
My aunt told me, when they give, find a way to take.
So what about people who are worried about taking advantage of these programs because they're worried about their financial future and paying things back?
Under $200,000, there's no personal guarantee.
Explain that in lay terms for people who may not be as comfortable with that.
Sorry. For many small businesses, when you borrow from the bank, they require a personal guarantee. What that means is if the business can't pay it back, they're immediately coming to the owners. And if there are 4 owners on a $100,000 loan, it doesn't mean that each one is liable for $25,000. They're all liable until the bank gets their 100,000. The SBA doesn't require a personal guarantee. If the business can't pay it, the business doesn't pay it. End of story.
Do you bankrupt your business then, or do you just not pay it? What does it do to your credit rating?
You might. Well, if you're going to not pay the SBA loan, it will first affect your credit rating and ultimately drive you into bankruptcy. So I wouldn't advocate who, I don't remember the name, but somebody borrowed on the PPP, went out and leased a big Rolls Royce in Georgia.
Not a good.
He's now a tenant of the federal prison system.
Yep. Well, that's one way not to pay your loan back, I guess. Suzanne wants to know if you can apply for the PPP to pay yourself and also receive unemployment.
The PPP acronym is Payroll Protection Program. If you're earning payroll, you're not unemployed. If you're unemployed, you're not getting payroll.
And I actually, that brings up another point of as far as payroll and employees. A lot of employees had to get furloughed or laid off. And when they went for unemployment, they're making a lot of money there. And I've heard from a lot of business owners that they're trying to hire back, or they're starting to reopen and they want to get their employees to come back. And the employees are saying, I don't want to come back. I'm making more money on unemployment. And this is where you as a business owner have to make a decision. Technically, if you have offered them their job and they have refused to come back to you, you can report them and they will no longer get that unemployment benefit because you've offered them a job. Some business owners don't want to do that. They don't want to hurt their employees. They feel bad, whatever. That's up to you. But just so you know, the law, the way it states, is if you offer them a job and they don't take it, report them and hire somebody else. Now, you got to do this in a way that if they're actually going to come back, you don't want to get them so angry that they're going to cause more problems working for you than they did not. But I just want to make everyone understand that. I know I've been hearing that a lot, that employees don't want to come back to work.
I've heard it a lot too. I've heard it anecdotally. I don't have any evidence of it in my client base, but I've also heard that there's a conflict between people calling back people for reduced hours versus them staying on unemployment.
Well, the unemployment system, which is administered by the states, has proposals, or provisions for that. So you would cut back on your on the amount that you would receive on unemployment.
Is that state by state, or is that a global thing?
Well, you file with your state unemployment office, but I believe the regulations are fairly uniform through all 50.
I agree. I think they may just be a little tweaked, but you could still be getting some unemployment if you've gotten reduced hours.
Okay.
You just have to let the unemployment agency know. And
excuse me, if I can riff on what you were saying, I've also heard from small businesses, again, small businesses, they don't have that many employees. 3 people don't come back, that could be 30% of your workforce. So I've gotten questions, well, if they're not coming back and I have to have a legit employee, why can't I put my son on the call, on the payroll? And then the question is, what is your son doing? If your son is 4 years old, bringing you coffee during your Zoom calls, that's probably not considered a legitimate payroll expense.
But I might want to pay for that.
But if your son is 16 years old and you want to bring him in because it's summer now and he doesn't have a job and you do need to make up, no problem. Go ahead, go for it.
There are social media experts in our child base that are desperately needed right now.
Yep.
Howard, there are no stupid questions. He's asking if you've already received the disaster loan but would like to get a higher amount, can you reapply?
I know they are revisiting because of the way money is being scarce. I couldn't guarantee anything, but I also couldn't guarantee that you're going to get you shut down. So I would suggest apply, but don't spend the money before you get it.
Good advice. I know that, there's a lot of opinion about whether or not any more money will be injected into the system to support small business. And as an industry, your vendors may look big to you, but we are all small business, basically. If do we think that any more money will get injected, or do you think they're just going to keep reallocating or reapplying the rules to the money that's already in the system and available?
I'll stick my neck out. There's billions more to come.
I'm not making a guess because no matter what I say, it'll be wrong.
Yeah, well, I'm not making a projection at this point in terms of, I think there will be more money. The timing of it is completely up in the air.
I would not make it the totality of your business plan. How's that for walking back on what I just said?
I think it just reinforces something that's a reality for all of us, which is that we are in uncharted territory, and learning how to deal with the unknown on a day-by-day basis is the new skill we have to develop.
And don't forget, each bank has their own rules. So, and I'll give this as an example. If you go, I had to apply for 3 different PPP loans at 3 different banks, and each one was such a different process. One bank only allowed me to apply for the amount that was going to be forgiven. So I had to calculate ahead of time to figure out what I was going to have forgiven, and that was all I could take. Another one was like a free-for-all. And a third one was this convoluted. They came back to me 3 different times, and I had to fill out 3 different things and upload into different areas. So make sure you speak to your bank and go to your banker. And that's why I said start the process now if you haven't already done it. You might as well get in line.
Good advice. Paul is asking, can you speak to the PPP for a sole proprietor? She's saying companies with employees can spend the 75% on payroll easily. Because that's one question. And also, can bonus employees, but an individual cannot bonus themselves to hit the 75% for forgiveness grant. So how does this apply to a sole proprietor?
Okay, here we go. So again, you may not be able to spend the whole 75%, but then it's a 1% loan payable in 2 years. Not the worst thing in the world. As far as bonuses, one thing you have to make sure is that with the bonus, you don't go over $100,000 annual salary, because then anything over $100,000 doesn't get forgiven. There were all sorts of nuances because some businesses operate on commission. And if the commission is due and payable in, let's say, June or July, what does that do to an employee's annualized income? Again, all nuances, many of which are still being ruled on. The forgiveness part of the SBA loan is not due until December 20th, despite the fact that you're supposed to be spending money over 8 weeks, essentially from May 1st to June 30th. Don't rush.
What does that mean? The forgiveness part is not due? Meaning won't get
the application for forgiveness. You get your PPP loan, knowing that some portion of it is forgivable. They've issued the application for how much should be forgiven, but you don't have any responsibility to pay any of the money back right away. Do not rush that application. If you do put things in the application and the metrics of the application change, you will have the ability to go back and revise. They've consistently said that, but why do it twice?
Just wait.
Let's hope there's a good busy season for Christmas. Do it in September, just before you ramp up.
And what about the 7A? What's the pay structure on that one? Do they start paying their 7A right away, or is there a period of time before they start paying that one?
That I'd have to check. I don't remember if there's a 6-month delay on the first payment.
I thought there was a delay. I thought it was either 6 months or a year delay before they have to make their first payment.
Yeah. Nobody is being required to make any payments right now.
And there's no prepayment penalties.
Right.
So even if you get it and then you have a great year and you want to pay it early, there's no penalties for that.
Okay. Paul is saying, but I was told a sole proprietor cannot bonus themselves at all.
Not true. Sole proprietor there's a sole proprietor, and then there are S corporations that have one owner, and I've seen those two terms conflated. For my sole proprietors, most of them were better off going on unemployment. Or in New York, they had this Pandemic Unemployment Act that even allowed sole proprietors to collect unemployment when they hadn't been able to in the past. I don't think that that's a national program, but I know it was available in New York.
So, Andrea, I'm going to be bowing out at this stage.
So thanks, Erich, for joining us. You guys, Erich has another webinar to do at 2 that he needs to leave for. If you have other questions that it would have been Erich's to answer, I'll make sure we get them over to you. Is that okay?
That's great. We'll take care of it.
All right.
And you're in good hands with Ann in any case. So.
Okay, great. Thank you.
Thanks.
Bye, Erich.
Bye, Erich.
Bye.
There's another question also on the loan programs. She's asking, where did it go? There we go. Catherine's asking exactly what parts of payroll are forgivable, gross, net, taxes, etc.
So what is forgivable is essentially the employee's gross salary, not the employer's match for FICA. Think in terms of gross salary and the taxes withheld. In broad terms, that's the safest way to look at it. Some states have additional taxes on payroll that can get added. There, I respectfully refer you to your own CPA in your state. But think in terms of gross.
So I don't see other questions coming through about the loan programs. I want to go back now to, because the loans are really important right now and they're helpful, but they don't really change the mechanics of the way we run our businesses. And at the end of the day, how well you run your businesses is going to determine how well you do in the future. So Ann and Joel have both said, look at your numbers, follow your metrics closely. And they started walking us through going through the balance sheet and taking a look at what's really necessary and what's not, and how to manage your inventory. And I want to go back to that part of the discussion for the last few minutes of this conversation. But audience, please keep submitting your questions, because I will make sure that they get asked and answered while we're still here. Are there any particular things that, for instance, you've seen a client or a business associate do that you thought, that's smart, I think that people should be thinking this way? Any kinds of tips you can give our audience so that they'll be thinking about the mechanics of their business differently?
So I will say that we've heard this before and everybody knew, and I know this is a numbers, call it, webinar, but I feel it's only prudent that we talk about, as you say, not only the mechanics, but the way they do business. I saw a question earlier, like, great, I should sell my inventory. Who am I selling it to? There is a world out there, and because of this COVID crisis, many more people are comfortable and are shopping online. And we have heard this for a very long time, and I know the jewelry industry as a whole has been very slow to adopting e-commerce. They have websites, and some people are selling on their websites, some are not. Some are quickly finding Shopify websites so that they could create shopping carts. But you have to think of it as not just, ooh, I've got a website and I've got a shopping cart. You have to start thinking about the experience. And what I mean by that is, how are you going to start to create an online experience for your client? And that means a lot more than just having a website with a shopping cart. So I think you need to look at things that Andrea has been talking about, look at some of the other webinars that are going on. Think about, I know we ourselves are launching a virtual presentation product. So it's about creating a different way that we're going to sell. Think of it as starting your business all over. We get so caught up with what we do every day and how we keep going through the mechanics. How about if we stop for a minute and say, if we were going to start our business today, what would we do differently? And think of it as a reset.
It's an amazing process to go through. Melissa Quick was on, Steve Quick Jeweler in Chicago was on a webinar with me the other day. And 2 years ago, Steve and Melissa went through that process. We want to reinvent ourselves, and totally reinvented themselves. And strangely enough, positioned themselves for this crisis in a looks prescient now, but really it was just the matter of saying, business is changing. We need to reinvent. And they got more excited about their business again in the process.
So,
Such good advice, Ann.
Andrea, you know me as a straight shooter. Now everybody is so much more accustomed to Zoom calls. One of my clients is going the guilt route.
What?
The guilt route.
Okay.
He is putting out notices for even Mother's Day gifts, which have passed. The focal point is graduation gifts. Get on a Zoom call. Do you like this? Oh, no, you'd like it in a different color? Great. How about this? Well, wait a minute. You can see what this looks like. Oh, no, you'd like this? Oh, you'd like a necklace. Wait a minute. Well, we have this necklace and now you have a personal interaction that people are so much more comfortable with, and they're buying. Why not?
Taking what Joel said and going even that step further. How do I create that virtual online experience? Yep, exactly.
And I don't remember who said this. It was on a webinar a couple of weeks ago, but he said, people don't need to go on your website to take a virtual tour through your store. If they want to go to your store, eventually they're going to be able to go back into your store. Your website needs to supplement the whole experience. It's got to be a part of the experience that's coherent, but not just trying to replicate what happens in the store. It has to be your brand, but a different version of the brand.
And that's interesting. You want to make sure that your brand experience carries through everything in your omni-channel. You don't want it to be really pretty here and then really not so great over here.
Right.
But these Zoom calls, they're closing 80% of the sales.
100 for some retailers. We have retailers that are saying, I've never had 100% close rate in my life, and right now I have 100% close rate.
Yeah. It's different.
You can also have somebody come on to a web chat and turn that into a video discussion in real time. So they visit your website, they want to talk. It's not just a text. You can video chat. So yeah, there are people to sell to. And what was it you said you saw the sales going back up, that people are selling?
I'm sorry, I missed that. Sorry.
You or Eric that was saying you're seeing the sales.
No, we've noticed that we're starting to see the sales go back up. Some of the clients I've been speaking to have been doing a tremendous amount of online business during the close even. They were still getting orders. From the vendor community, I would say make sure you're set up to drop ship if you're not already doing it. Make sure you're offering to your retailer services that help them in their online community. So from the vendor community, do you have all of your pictures of your products in beautiful, up-to-date type of format that you could supply images for that virtual experience, whether it's a virtual presentation or whether it's on your website? Make sure you are communicating with your vendor partners and with your retailer partners. Again, we've got to become a much more cohesive society. You know, Andrea said, I've been in this industry since I was pretty much born. And one of the things that I've noticed growing up was there was almost this wall between a vendor and a retailer. And it was a wall of animosity where retailers felt that vendors were just trying to sell them more stuff. And vendors were feeling like retailers don't respect me and I need to get more stuff there. Well, guess what? We've got to start not fighting against each other, but working closer together, more collaboratively.
I just wrote a note. I want to do a webinar on supply chain harmony because it's something, supply chain harmonization is something that other industries do beautifully and we're not good at it. So Ann, I'm going to come back and do that with me.
You got it, because that's what we do. That's the whole platform I built over the last 5 years, is because I felt like growing up, I knew my best clients were the ones that worked closely with me, whether it's sharing inventory, being able to have me help them manage their inventory, because I knew my line and they're busy. They're running a whole store. So how do we take everybody and let everybody do what they're good at? And how do we work closely? From a vendor perspective, how do you know what the consumer wants? From the retail perspective, look at your consumer behavior and make sure your vendors understand that so that you are filling the proper holes.
Yep.
Andrea, you and I started to talk about positioning a business for the future, and we started talking about family members. So this may be a good time to bring younger family members in and ask them their opinion. And I'm going to go off on a limb again. Listen to them. There's a lot of people coming right out of college with different ideas for the future of a lot of businesses. I do business valuations. So when businesses are changing hands, either because of a passing or a transfer to the next generation, they always need to know how much the business is worth. And this is the tax issue. When I go ahead and value businesses, we're looking at the strength of the customer base, the strength of the supplier base, the analytics of the balance sheet, whether there's too much debt, and most of all, the strength of the management team. Get that going for tomorrow. The strength of the management team you've had, which could very well be grandpa because his name is on the door, that may not be where you need to go for tomorrow.
And smiling because her family went through that exact process. And Ann and her sister helped transform that business, and Ann became a CPA in the process. It's a great way if you're always interested in transforming your business to allow new energy to push you forward.
Right. Yep.
Hussein saying Howard Jewelers organizing sales meetings on Zoom. Hussein, we are going to do a webinar on that topic on June 18th. So if you go to the MJSA website and look at the webinars, and we'll give you the links also in the follow-up email with this replay. So we are going to do a webinar called Combining Live and Virtual Selling. And we'll dig really deeply into that. And I know that recent webinars from In-Store and MJSA, in both series, we've talked about doing that kind of selling. So we'll go deep on that.
I saw one come up about vendors shipping directly to customers.
Yeah, that's what I was just going to ask. Angela's saying, are we seeing more vendors moving toward direct to consumer?
I just want to stress, talk to your CPA because there are sales tax issues here that nobody's talking about.
Right. And I think it's more so right now. There's vendors have always, especially the bigger brands, we've seen that over the years, are moving to that B2C platform. However, in general, I think that it's about the vendor working better and closer with their retailers. And that's the way I think, me personally, I think that's what we need to encourage.
And I think that most of the vendors, in my experience, don't want to do the direct to consumer. They want the retail relationship and the distribution they get from the retailer, but they do need to know that they're going to be working in partnership and not the bank. Going back to what we discussed earlier, if we keep trying to force the vendors to be the bank and they can't be the bank, they have to stay in business too. So we have to have these strong relationships so everybody can make money.
Mm-hmm. Exactly.
All right. I am looking for any last questions. I see some typing still going on. Ann and Joel, any last thoughts you would like to make sure this audience has before we wrap up? I hate that question personally, but I think there's stuff out of it.
I will say overall, we said it before, rethink, restart, regroup, think about utilizing the data you already have at your fingertips to start making business decisions, whether that's your financial statement data, whether that's your inventory data. Utilize the numbers, because a lot of times we get caught into that's a really pretty pearl necklace my dad bought with an opal center, and it's just so nice. Okay, that is nice, but does it make sense? So really, you still got to use your mind. That's why we're all in this industry. We're jewelers. We understand that. But use it in conjunction with other metrics.
Everything is new. You have to treat that everything is new. You may know more about it by being able to rely on something from the past, but don't just take it as stock. You got to reevaluate everything. And we still don't know when and how business is coming back.
Yep. So we learned to ride the roller coaster, right?
From an optimist.
All right. Well, it looks like we are out of questions. I would like to thank both of you so much. And my thanks to Erich again. I'll have to send them virtually after the fact. But thank you to Ann Arnold, who is the Chief Technology Officer for BIG and the new chairwoman. Congratulations for JBT. She's also on the board of MJSA, which is producing this webinar series. So she's a busy woman. Thank you very much to Joel Peck, who owns Joel Peck and Associates, and he's a CPA serving a broad range of business clientele and individuals. You guys have given amazing advice today. and you make it fun. So, I mean, when we can talk about things like accounting and operational issues and you make it fun, that is a win for everybody.
Yeah.
You guys have been great. I
Thanks.
also want to thank MJSA for producing this series. It's a gift to the industry. I so appreciate that you've made this available for free to everybody and will continue to be free through the end of June. Weekly, we have a really exciting webinar set of I can't talk anymore. We have a really exciting series of programs coming up for you over the next 6 weeks. You will get information about it in the follow-up email. You will also get links to Big's website, which Ann shared, has a lot of downloadable tools for you guys to use. Buyers Intelligence Group crunches more data than I think any other jewelry industry group in terms of operational and inventory data. Does anyone crunch as much data as you guys do? I don't think.
I'm not sure, but we're pretty up there, yeah.
We're pretty up there. So it's a great resource that she's making available. I encourage you to take advantage of that. And with that, I think we'll wrap up.
Great.
So thanks a lot, you guys.
Thanks, Andrea.
All right. Take care. Bye.